quick announcements before we get started. So it looks like this door, just as you're coming in and out, if you let it close a little, oh, maybe it's not gonna work now. Never mind. I thought if you just let it go gently, it won't lock it. I don't know. All right, scratch that first announcement. It doesn't matter. One of my colleagues is doing some research right now. So this link that I posted here, it's just a few minutes to get entered for $20 gift card raffle. If you have a couple minutes to fill it out, that'd be great. It helps them with their research, and that's all good stuff. Also heads up with taking start of term attendance, right? This is really important if you're getting any sort of financial aid. This is basically my way of taking attendance. Just take this start of term attendance quiz. It's not for a grade, but it is for reporting purposes. So this is due on the 1st. It takes a minute, asks you if you're attending this course or not. You can answer it either way. I know that you're attending if you respond to this prompt. So just take a minute, take that quiz. I'll be submitting attendance at the start of next week. Also, classes are recorded and they'll show up under class recordings here. Just follow the FIN3010 recordings link that'll bring up to this class. So if you miss a day, it's okay. Just watch the recording, make sure you're keeping up with your work. And that should help you out. If you have any other questions, you can post on the discussion board, ask in class the next time, or ask your fellow students. Yeah. Any questions before we get started? All right. So today, we're going to talk about a few more qualitative things before we really start getting into the real concepts that are core to this class. So we're going to be talking about the goal of a firm, what's the motivation for a financial modeling structure that we'll try to understand, what's the general structure of companies, what is our goal and role as financial managers, right? Most of you are not going to work in this field, but it doesn't mean it's not important for you to understand how finance works because, right, like I mentioned last time, you'll still be affected by the decisions of the finance department, right? We help decide where funds are going to be allocated. Your salary in the future is going to be determined by that fund allocation. So it's important for you to understand and be able to make a good argument for why you deserve the capital allocation that you'll be receiving. And what's the sort of decisions that financial managers are going to be making. All right, so to get this all started, it's important to think small, and then we can kind of build from there, right? So imagine yourself as a business owner, right? Generally speaking, do you want to be paid less money? And does anyone here want to make less money? By show of hands. Are you sure? That's generally the case, right? Generally speaking, nobody wants to make less money, and in general, people tend to want to make more. Only one time have I ever received a response like, no, I want to make less money. I want to donate all my money that I make, which is great, but you still got to make that money if you want to go on to then donate it, right? In general, people need more resources or want more resources, and that's the general structure of a firm, basically follows that premise. Right, so if we kind of think of that mindset, right, if you're the single owner, the single employee of a business, right, you're still trying to maximize your income, right? There might be a point where you're okay and happy with what you're generating, but in general, right, people want more income to less. And if we kind of simplify a lot of management decisions that are being made, it should optimally be from that standpoint of people are generally trying to make more money. All right, so the broad goal of a firm is to maximize shareholder value. The broad goal, how exactly we define shareholder value is somewhat up for debate, but there's going to be a concrete way that we're going to define it for the sake of this course. All right, so a lot of people argue that earnings per share should be the measure of shareholder value. A lot of executive contracts are tied to earnings, particularly earnings growth over a quarterly and an annual basis. So there's that argument. Others argue that it's just the stock price. And that's another part of the reason why you see so much focus on management talking about the price of their company stock. If markets are perfect, which they're not, they're pretty good at pricing assets, but If markets were perfect, then the price reflects the discounted value of cash flows the asset is going to be. We'll get into what that really means later in this course. But this isn't necessarily the best way either, because market prices can drift pretty far away from the intrinsic value of an asset. Arguably, the best measure is going to be free cash flow, and this is what we're going to be using to define shareholder value in this course, free cash flow. And this is also really what differentiates finance from accounting, is our focus on what is value. Right? Accountants tend to focus on profits. We're going to be focused on cash flows. Right? And we're usually going to assume that we're dealing with a value maximization process. In other words, we're trying to increase our free cash flow. In reality, right, at least the appearance of it, right? There's a lot of stuff that goes on in corporate decision making. We'll talk a little bit about it today, right? But in reality, there's a pretty significant drift from true value maximization in a lot of decisions that we see upper management making. All right, so why are we focused on free cash flow? The basic idea is shareholders in a company have the last claim to any cash that a company is generating. Every other single stakeholder in a company has claim to a company's cash flow before shareholders. So the basic idea is if you pay all other stakeholders before the last person in line, that means everyone in line is getting their share. Right, there's been a lot of arguments for and against this, mostly against this in modern times. Right, there have been some issues, particularly with pay policies and executives, and what the pay policy is for executives relative to the median employee of a company. But the basic idea here, the economic argument, is we're trying to pay the last person in line. As long as that last person in line is being paid, everyone else is getting their share as well. And by the end of the day, we'll talk about some of the reasons why we see this pay disparity. All right, so how are we defining cash flow? I just want to show you this at the start of the term. We're going to be working on this all semester. Don't worry too much right now about memorizing this. We're going to be dealing with cash flow a lot. What I want you to understand is basically there's a difference between what I'm talking about with cash flow and what you've seen on accounting, from the accounting side, looking at profits. All right, so cash flow, the basic idea is money coming in, money going out. That's the basic idea. And free cash flow in particular is net money coming in from the company's operations. All right, and so that's what we're looking at here. We're adjusting the net income of a company for true changes in cash over time. All right, so this is just one measure of free cash flow. There's a couple others that we're going to discuss as well. This is the bottom-up measure of free cash flow. So we start with net income, and then we make all of the cash changes that actually occur over the time period. So starting with depreciation and amortization, the example I always like to use is driving a car off the lot. What happens to car value after you buy a car? Yes. Now, when you're driving the car off the lot, do you take out your wallet and start throwing money out of the window? No, it's just the nature of assets over time. As you use things, they depreciate in value and they have less resale value. Same idea with cars, computers, anything that you're using in a production process. All right, and so what's going on with depreciation here is it's not a true cash outflow from a firm. It's a pure accounting expense. When companies are depreciating assets, it's a discretionary expense that they're including on their income statement, reduces their taxable income, which is a good thing for companies. Right? But in general, depreciation is not a true cash outflow. What is the true cash outflow is buying that car. Right? When you buy a car, that's money that you're spending. Right? Even if you're taking out an auto loan and paying it over time, that is the money that you're spending on the asset, not the depreciation of the car. So we're adding back depreciation and amortization because it's not a true cash outflow. And we're netting out capital expenditures because it is a true cash outflow. When you buy a car, that's money leaving your bank. Changes in net working capital, it's a little bit more complicated. And again, we'll get into this more later on in the course. The basic idea is when we're looking at a balance sheet, liabilities reflect money coming into a firm. Assets reflect that money being tied up within the firm. So basically what we're looking at here with change in net working capital is the mix of money coming in through freeing up cash in short-term liabilities and tying up cash in short-term assets. All right, so when we're talking about free cash flow, this is a true measure, a tangible change in the cash position and performance of a company over a given time period. This can be for the company as a whole. Generally speaking, that's what we're going to be doing when we say free cash flow. When we say free cash flow, it's what we were just looking at, free cash flow to the company overall. It can also be measured as free cash flow to equity, right? In other words, free cash flow that's attributable purely to shareholders. And the way that we measure that is adding in net debt that's being issued over that time, right? So net debt being the difference between debt being issued, debt being paid for and retired. So it's also important to note that cash flow is related to net income, as we just saw. Oh, question, yes.
Yeah. What do you mean when you say a tangible change in cash?
So net income is the accounting profits that are booked. When we say change in cash, we mean cash actually changing hands. So when you're looking at the income of a company, cash does not necessarily have to have changed hands for that to be recorded as a profit. So financial statements are based on accrual accounting, meaning when an economic event occurs, not when cash exchanges hands. So for example, if a company buys part of their inputs to production and they don't pay for it right away, that would go to accounts payable. Meaning they have an input for their production, they haven't paid it. So they don't have the cash outflow yet. So it's recorded on the balance sheet, but it's not recorded in the cash flow. Right? So the difference between net income and free cash flow is we are adjusting for cash actually changing hands for a transaction rather than the event occurring, right? Rather than like we have an agreement that we will be exchanging cash in the future. So that's basically the difference. So profits is we agree to this transaction. Cash flow is we've paid for the transaction in full. That's the basic idea of the difference. All right? And so the only time that free cash flow is going to equal net income is if and only if all sales and expenses are paid for at cash at the time of transaction. And in general, that's not how companies function. Very often, sales will be made on credit. Very often, purchases will be made on credit. Very often, there will be financing terms for large expenditures like capital expenditures. Very often, companies will have depreciation and amortization expenses that will pop up on their income statement. So very generally speaking, free cash flow will not be equal to net income. It's related to it, but it's not exactly equal to it. All right, so why don't we focus on net income when we have this very clean and easy measure of profits over time? There's a few reasons. First and foremost, net income doesn't reflect the tangible change in cash. Right? The promise for payment is not the same thing as being paid. This is especially going to be noticeable when we start talking about time value, right? Because if I tell you, hey, I'm going to pay you $10,000, is that the same as as me handing you $10,000 and you having $10,000 in your hand right now? It's not, right? The promise of payment is not equal to the payment itself. And when we start looking at time value, we're going to see that there's some really tangible effects of that situation. Right, so net income does not reflect tangible change in cash. Cash flow does. And free cash flow reflects value that shareholders can claim for themselves. One thing I forgot to add here as well, free cash flow is not as manipulatable as net income. Right? Part of the reason that companies have to report their cash flow statements now is because it used to be much more common for executives to report financial statements in a way that present the company's performance as being better than it actually was over a given time period. You can't do that when you're looking at a company's cash flow because once we make those cash adjustments, that basically negates any levers that management has in managing their financial statement reports. So like I said, this is just a brief glimpse into cash flows. We're going to be talking about this more over this semester. You don't have to worry at this point exactly how we're measuring it. All the inputs and all that. We'll be going over this in greater detail later on, but it's just something important to put out there right away because I'm going to be referencing it over the next few weeks before we get into the details of it. Any other questions on cash flow? Yes.
The formula you gave, why do you also have a rearranged form of it?
Here?
Yeah.
So basically, we can use different methods to arrive at the same result. Right? And so when things like that happen, I'm going to be trying to show you the different ways that we can arrive at the same answer, basically. So that's all I'm doing here is just rearranging basically where we're adding and subtracting the values.
Okay, makes sense.
These are equal to one another. All I'm literally doing is moving some of the values around. But mathematically, they're equal.
Gotcha.
Any other questions? All right, so types of companies. There are three general types of companies. We're basically just assuming that we're going to be talking about corporations after this section here. The reason being is corporations have public information. That's the nature of their being, right? Once a company goes public, their financial statements are required to be posted publicly. That makes it very easy for us to evaluate them, right? Same thing can't be said for a locally owned independent company. Right? Their books are going to be private, much more difficult to get a hold of. If I go and ask someone at the Square if I can have their financial statements used as an example in class, they'll probably say no. Although I've never tried it, so maybe I'll see. That's my luck a little bit. But for the most part, we're going to be talking about corporations just because that's what we have information on. But in general, when we're dealing with cash flows and time value, the process is the same whether we're talking about the largest public company in the world or a small company just independently owned. All right, so the types of companies we have: sole proprietorship, just a single owner, you're running a company by yourself. Partnership, you have at least one additional partner who has equity or ownership in the firm. And a corporation, which is a distinct legal entity, you can have very many owners. All right, so each one of these structures has upsides and downsides, where it be. Right, with the proprietorship, the upside is you get all the benefits, right? Every additional dollar in cash that you generate is going to you, which is great. On the downside, you're also taking on all the risk. Right? Taking on something by yourself can be much more difficult and much more of a burden because you're the one that's planning everything that's going on with the company. So that's a lot of responsibility to bear. You're also potentially exposing your own personal finances to the running of this company, right? If you owe someone money for a purchase in inputs, you might have to pay out of your own assets to cover that debt. There's also a potentially limited lifespan. It can be difficult to transfer ownership, especially if you have a relatively unique company. You may have a difficult time trying to sell that off if you're looking to retire. Right? There are some fields that easy to sell off, right? So if you're an asset manager and you have people's assets under control, you might be able to find a larger bank that would be interested in purchasing those. But if you're making like a unique, I don't know, a unique bourbon or Tennessee whiskey, right? We're in Tennessee whiskey. It might be difficult to find someone that would be interested in purchasing that. So transferring ownership can be very difficult. You've got to spend a lot of time trying to find a buyer, and you're going to have to put a lot of information together in order to convince them that it's worth purchasing the company that you've built up. And lastly, there's going to be limited capital, right? If all you have are your own resources, it's going to be a lot more difficult for you to be able to put money together and fund projects that you might be interested in investing in. Then we have a partnership. In many ways, a partnership is kind of a mix between proprietorship and incorporation in terms of the upsides and downsides. So on the upsides, you're splitting rewards only among your partners, right, depending on your share of equity within the company. So that's nice. You still get a lot more of the cash benefits from this company that you're running. If you are established as a limited liability, now this company is kind of separate from your own personal finances. So you're kind of hedging your risk and exposure to any debts or money that you might owe. If the company is a general partnership, then you still have the unlimited liability that you would have with a proprietorship. So you're still very much exposed. Also similar to proprietorship, you have a potentially limited lifespan, but you have the added benefit of you at least have a handful of partners in this company that have a vested interest in the ongoing operations of the firm. So they might be interested in buying out your share of the partnership. And also limited capital, but again, the more people that are involved in a project, the easier it is generally to raise capital. one thing that's always important when you're working with other people, make sure you get agreements in writing. Verbal agreements don't make good legal contracts. So if you ever consider making a company of your own, everything should be in writing. Make sure you have a paper trail. All right, corporations. They're limited liability. That's the main benefit of a corporation. It's its own distinct legal entity. And that's basically why the capital allocation process can work so well with these is, right, imagine if you were going to consider a business venture, but the downside is if it goes wrong, you lose your house and your family's going to be homeless and you're going to be struggling to eat, right? I think it was 500 to 600 years ago, that's how equity partnerships would work. People would be personally exposed to any venture that they would consider going on. Being able to separate out the risk of the business venture failing relative to the person who's running the business failing really helped to increase capital allocation over time, and people were willing to invest more capital and take on riskier projects and develop the sorts of goods and services that we enjoy today because they're not personally going to be liable if their business were to fail. It's a lot easier to raise capital. Right, when a company goes public, they're a better known entity. They tend to have larger cash flows, and so it's going to be easier for them to get capital from external sources, venture capital, banks, such. There's going to be more attention to the company and their products. Right, I've learned of new companies just because I saw them going public on the market. Right, so they get to go to their exchange, ring the opening bell, and that itself is a great promoter for the products and services that they're selling. So they get a lot more free attention for whatever it is they're producing. And it's really easy to transfer ownership, right? If you own a public company, you can go buy or sell more of their shares. You just go to your broker. It takes a minute or two during the trading day. Usually if it's a liquid company, it's immediately executed. On the downside, there's a lower share of the profits, right? There's more owners, potentially millions of them in large public companies. So you're going to be splitting the company's profits between all of them. They are the last to be paid out in bankruptcy. Right. Lowest claim, every other stakeholder in a company is going to be paid out before shareholders. And then there's also the double taxation on dividends. So taxes on the company's income as well as dividends being paid out to shareholders. All right, so when we're looking at the general structure of particularly public companies, this is theoretically the chain of command with the company. You have the owners or the shareholders. Then you have the board of directors who are tasked with being the intermediary between the owners and executives of a company. And then you have the executives. Usually the CEO has the largest responsibility. Underneath them, you have all the other C-suite executives. All right, so theoretically, again, companies are structured with owners on top and having the say in what the company's operations are going to be, or the long-term goals of the company. So they have a claim to shares of the firm, and they have a right to equal shares to any dividends being paid out, as well as voting on any issues. Now, there are companies that have dual listed shares, right? So sometimes that means one share will have a higher claim to the company's dividend payouts, or they'll have a higher claim or a higher voting right for any matters that are being voted on. That's particularly important to executives that are original entrepreneurs that are still running the company, right? Meta is a great example. Mark Zuckerberg has a class of shares that gives him more voting rights within the firm. And so he has an outsized say in the direction of the company that he founded. But in general, within any given class of the company's shares, people have equal rights to dividends and voting on important matters. And those typical matters are board composition, executive pay, and mergers and acquisitions. Those are the typical things that shareholders were going to be voting on. But it's still important to think that even though we're dealing with a much larger, complicated corporation, we should still think of it as a really small individual company that's just trying to maximize cash flow, right? The general idea is maximize residual income. In other words, cash flow being generated at a given time. I already mentioned that one. So the board of directors are legally tasked with looking out for shareholder rights. They're intended to basically be the government of a firm. They're supposed to choose the chief executive, set their pay, approve general budgets for the company, as well as the compensation for upper management. CEO is usually the head and the face of a company. Right? They're generally responsible for developing, achieving the company's goals, and being the communicator with the firm. Right? CEOs get a lot of publicity. Great example is Starbucks' new CEO. Right? He's been in the press recently, and we'll talk about him when we get to some issues with the structure of ownership. Another one is Boeing. Right? Boeing's been in the news a lot over the last few years. None of it has been good. And so they have a new CEO that is hopefully going to be changing the direction of that company. Right? I fly relatively, well, not frequently, but several times throughout the year. So it's nice to know if the window is going to stay intact during the flight. I mean, companies can have chief roles for basically every other important sector within the firm. These are some of the most common ones: operating officer, financial officer, technology officer. But as companies grow, basically they can have a chief role for any role that they consider to be particularly important. All right, so under the CFO, we basically have accounting and finance. All right, so what we're going to be focusing on in this course, basically figuring out capital management projects. We'll talk a little bit about working capital. We're going to talk some about risk management, not as much about investor relations. And then we have the accounting side of things, right? The basic bookkeeping, verifying those books and making sure that the company is paying the taxes that it owes on time. All right, so the goal of the company is to maximize value. We do that by increasing cash flow. So what's going to be the role of finance in increasing that value? By far, the most important thing is capital allocation, right? Figuring out projects to invest the company's money in over the long run. Over time, this is by far the most important thing for companies to be doing, because if they're not investing in value-adding projects, then eventually the company is going to be basically run over by competitors. Right? If Apple never invented the iPhone, it wouldn't be the company that it is today. If Microsoft didn't transition its software to the sort of products that we use, it wouldn't be the tech giant that it is today. All right, so companies need to invest capital and find new innovative projects to work on, because if they don't, eventually they're going to be outcompeted and tend to decline in value over time. And that's going to be one of the primary focuses by the end of this course, is figuring out how can we optimally allocate capital over time. Secondary to that is making sure that the company has financing available. About 3/4 of companies' projects are funded internally. They use previous year's profits to fund any sort of investments, right? But that other roughly 25 to 35% that companies need from external financing is really important when they have projects that are worth investing in. So being able to have that capital budget and that allocation available is important, and it's done through making sure that the company has sufficient arrangements in order to have that external financing. When they do raise capital, they also want to try to minimize any financing costs that they're going to be occurring. A good example of that is raising equity offerings, right? The IPO, initial public offering, investment banks historically have charged up to 15% of the issue, right? So if you're $1 billion company and you're being charged 15% of the issue, that's $150 million right on that issue that you're just paying to issue that equity. So financing costs can be really expensive. Over time, with the evolution of technology, right, companies are trying different things. So a good example is some companies have started to direct list, right? So rather than having an investment bank underwrite their IPO, they'll try to go to market directly themselves, and that can save hundreds of millions potentially over time. Managing working capital, right? This is something that can affect us personally in general when companies mismanage their working capital. Great example was during the pandemic. Does anyone remember running out of basic things that were fully supplied in grocery stores? Yeah, it happened a lot. And a lot of that came down to working capital mismanagement, right? A lean production supply chain is really great for increasing cash flows, but it can be a little bit more fragile, as we saw, and when things go awry, much quicker to spiral out of control and result in poor outcomes for both the companies and their consumers. All right, so I kind of alluded to what we've been talking about as being the theoretical structure of some things. We are going to be assuming that companies are operating to maximize cash flow. Things are a lot more difficult to evaluate when we bring in psychological biases that people in actuality do have. But it's important to note a couple of these things right off the bat, just to keep in mind, right? Reality is different than what our models might be able to predict, sometimes in really complicated ways. So the basic start for this discussion is that in general, people have a tendency to be selfish, right? Everyone thinks more about themselves than they do about any other person, and that's just the nature of our being, right? That's just how we exist. It tends to result in people trying to do well for themselves, right? Trying to better yourself in any way is great. Problems can come about, though, if someone tries to do well for themselves at the expense of others, right? So making more money, everyone here, I think, agrees that they want to do that in general. Is that okay if you do that by pickpocketing the person next to you? No, right? That is stealing, and that's at the expense of another person, right? So balancing doing well for yourself versus doing harm to others can be a difficult thing to do, and we see this kind of play out in some ways with large companies especially. All right, so when we have a separation of owners and managers, it can result in a problem that stems from this basic selfishness that people have. Right? Economics is often referred to as the dismal science. Discussions like these are a big part of that reason. So this is what we call an agency conflict. Basically, managers or agents are separate from the owners, and that often can result in managers making decisions that benefit themselves, often at the expense of the owners. And we call that agency cost. Right? So anytime that there's this separation of owners and managers, we have an agency problem. And any costs that result from this agency problem are agency costs. And we see those come up very frequently when we're looking at public companies. Right? So I mentioned Starbucks. Corporate jets are one of the very frequent aspects of agency costs that a lot of companies engage in. Right? Flights are available very frequently. Most public companies are located in an area, easy access to an airport. It's easy to get on an airplane, take a flight somewhere. But executives at large companies basically almost always argue for access to a corporate personal jet that they can use at their own discretion. Right? And the new CEO of Starbucks has been making headlines because they're planning on commuting every day. I think the round trip was something around 1,500 miles or something like that per day. Right? And so that is a perfect example of an agency cost. It benefits the company in no way. Very likely they could have found someone who was willing to work where the company's headquarters are actually located. But rather, the new executive was able to argue that they're going to need this corporate jet for them to effectively be the chief executive of a company. Right, so corporate jets are a good example. Lavish C-suites are another example. And this is something that you see across the board with companies. Management tend to like to give themselves the nicest offices. Excess dining, and one of the means through engaging in some of these agency costs is through mergers and acquisitions. Right? Looking over the history of mergers and acquisitions tends to show that acquirers or conglomerates tend to lose value over time. And the problem with that is a lot of management's compensation contracts are tied to how much assets they have under their control. Right? So the natural result is managers will often try to increase the amount of assets that they have under their discretion in order to argue for larger payouts. But it results in a less effective firm that is generating cash or losing cash relative to if they had just stayed a focused firm. All right, so the board of directors exists. So how can agency costs arrive if the board is supposed to be looking out for the interests of shareholders? The basic idea is they might just not be willing to do that. They could be incompetent, but for the most part, research that looks into agency costs finds that very often boards would rather just make the CEO happy. There's basically an unvirtuous cycle between boards of directors and executives at a company, because often executives at a company will elect the board of directors, who now have a very nice job, right? They meet usually between 4 to 12 times per year for several hundred thousands of dollars, and it's a cushy gig, right? So if you're making good money, that's relatively low cost, your incentive is to try to keep that job typically. So very often boards just want to make executives happy because they have this really nice job that they want to keep. So rather than looking out for the shareholders, which is their legal task, they often look to just make the chief executive happy with whatever they want to do so they can hold on to their board position. And so that's one of the large reasons why we still see agency costs occurring. So how can this be fixed? A couple options are available. So shareholders can replace the board of directors. That rarely happens because it's a complicated process and most people don't get actively involved in companies that they're investing in. It's mostly just a passive situation, which, as we'll talk about later in the semester, ironically is the best thing to do as a shareholder most of the time, just passively invest. They can also sell their shares if they are extremely unhappy with the company and don't think it's going to improve, or try to encourage activist investors to step in. The board themselves, what they can do to try to alleviate the agency costs are basically tie management compensation to performance. And there's been some improvement in this area, but still not great, right? So one version of this tying is our stock options, right? So basically, if the company reaches a certain performance threshold, the executive will receive the option to buy the company shares at a relatively low price. They can have bonuses tied to performance. That's very common, but unfortunately, these bonuses are very short-term performance tied, often quarterly and annual basis, and usually focused on profits rather than cash flows, and profits can be managed very slightly. And lastly, there can be threat of a proxy fight. Right? So basically, we're going to be replacing the executives of a company. Typically, executives don't want that. So like I mentioned, shareholders have the right to vote on important matters. If a company isn't doing well, maybe outsiders will start taking over, right? That started happening at Southwest recently. The company's been lagging its peers in its performance, so some outsiders started trying to buy up the company and influence their decisions. This can be done either aggressively or with the company agreeing to it, right? If managers realize they're having issues and need some outside help, they might be open to a takeover bid. And you basically need the majority of shareholder votes, not necessarily the majority of shares, I should say. Right, so either way, you can kind of result in the change that you're looking for. Takeover threats can also help incentivize management, right? If you tell someone that they're going to lose their job if they don't start performing better, that in itself can maybe incentivize them to perform a little better. But unfortunately, over time, managements have been pretty clever in how they structure some legal contracts within the company. Many of them have started using poison pill strategies. This has become a popular strategy over the last 40 years or so. Basically, the idea is they make it more and more difficult for a potential acquirer to take over the firm, so it reduces any takeover threat that outsiders might be posing. And the basic idea here is basically selling shares for lower and lower prices, usually to outstanding shareholders. This reduces the per share price and increases the number of shares that an acquirer would have to take over. Any questions on corporate structure? All right. So if there's no questions, that'll be it for today. Next week, oh, yes.
Just like theoretical, splitting, like stock splitting, is that like anywhere close to poison pill strategy, or is it not really?
I don't. No, I think it is relatively separate. That's kind of up to management discretion. The basic idea is that should not matter. If they have the value and just double the shares, technically it's the same value.
Yeah.
Issuing more shares without that split and price adjustment, that can result in the dilution.
Maybe it is a brain connection. Thank you. Yeah, that makes sense.
I don't think okay. Just making sure. Okay.